we love doing ranges. So Kathy has a 20 basis point range above or below 290. So we're talking 270 to 310 because
for how long?
Things, as far as inflation goes, it's not changing that rapidly.
Is that a 12-month?
Yeah, well, that's probably about a 6-month range for now.
Take it, though.
Yeah. Well, a couple of reasons. One is that although wages are picking up, we're not seeing it translate into higher inflation. So inflation is steady, and inflation expectations are actually fairly steady. So that doesn't really give you a lot of impetus for pushing long-term yields up. Secondly is the Fed is getting more hawkish, and that's just flattening the yield curve. So the more hawkish they get, the more you actually just see a flatter curve rather than a big boost up in rates.
All right, let me throw something at you that Jan Niffen, our retail analyst who comes in, threw at me yesterday. He points out, because you're looking at, I think, 120,000 extra hands for the holidays that Target's thinking of hiring, 80,000 for Macy's, on and on through all the retailers. They are all hiring massive amounts of part-time workers for the holidays. Because of their low unemployment rate right now, he's speculating that you're going to have a hard time paying them $10 or less to do that. You're probably going to have to pay more to do that. Retailers are able to do that right now because, A, they've got a great consumer environment, but also they've got a much better bottom line because of the tax cut. So is there a point where that sort of behavior does spiral kind of rapidly into a more inflationary environment?
You know, it could, but we're just not seeing it, right? So the other thing is that a lot of those...
But you might at the holidays if you see this happening.
You might see a little bit of a bump, but, you know, we're seeing wholesale and prices kind of flatten out as well. And you're just not seeing those workers go out and chase goods. So if the old saw is that it's too much money chasing too few goods, I'd argue that there's not too few goods out there. We're still pretty amply supplied.
Fed President Bullard is not a voting member, but what do? Trot him out to show the other side? Because when he was on, his biggest thing he wanted to get across just a couple weeks ago was that the Fed knows how dangerous it is to flatten the yield curve and that they're not going to be loath to do it. You think they might do it?
Well, then we have Lael Brainerd on the other hand and a couple of other Fed governors saying, well, it's different this time, right? We're not afraid to invert the yield curve if we see inflation really
So you don't know who
up.
to listen to. I wish they'd get their story straight. Now,
it's just different opinions.
Was I still reeling from the back-to-back Jack Lew, Barney Frank interviews? And when was Jan Niffen on? Was he
wasn't.
on
He just emailed me.
Oh, okay, because you said you were interviewing him. And
no, I spoke with him.
I thought I totally didn't know he was on, and this is happening to me a little bit lately. I don't know. Kathy, you are on the show right now, aren't you?
That was not stuff that.
So he was not on the show yesterday.
No,
but it could have been because I was kind of like reeling, Jack. You know, the stuff that's.
I talked to him not on the show.
Okay.
Or I emailed with him, I should say. Clarify.
So, Kathy, so this makes you a little bit worried about high yield and other corporate bond investments, then?
Yeah, you know, we're not underweight high yield. We're still sort of neutral because we think you continue to earn the coupon, and the coupon's pretty attractive relative to other yields out there. And the environment's still good for corporations. Obviously, earnings are good, and the economy's going well. So there's no reason to go underweight, but what we're cautious about is valuations. And when we get to the point of if the Fed actually does invert the yield curve and tighten credit conditions, then, you know, the weakest links are usually in the high yield area, maybe floating rate notes, the leveraged loan area.